Hello everyone. Today we're going to have a look at Accountancy Basics for Non-Finance Candidates Part 2.1. This video explains how to prepare accounting journals. About the trainer, I am Vijayalakshmi Balakrishnan, and my core expertise is in SAP data migration, finance, controlling, business consolidation, business warehouse, and business planning and consolidation. I have around 15 years of experience in SAP implementation and support and 10 years of domain experience. Each challenge is an opportunity. Make the best use of it. Change is the only word that doesn't change. Everything else changes. Best thing you can gift another human being is building their self-confidence. Teach them how to fish. Don't fish for them. The contents of this accountancy program is split into 3 parts. We already have a video for part 1, and part 2 is further split into 5 sections. Today we're going to have a look at part 2.1, which covers the accounting terminology, accounting equation, and journals. Welcome to the world of accountancy. Accounting terminology. These are some of the terminologies which we will be coming across when we are dealing with journals or accounting transactions. Transaction means the exchange of money or money's worth from one account to another. Events like purchase and sales of goods, receipt and payment of cash for services or on personal accounts, loss or profit in dealings, etc., are known as transactions. Transactions are of 3 types: cash transaction, credit transaction, and non-cash transactions. Cash transactions is one where cash receipt or payment is involved in the exchange. Credit transaction, on the other hand, will have cash either received or paid for something given or received respectively, but gives rise to debtor or creditor relationship, which means that the cash will not be paid or received immediately, but after a period of time. Non-cash transactions is one where the question of receipt or payment of cash does not at all rise. For example, depreciation, return of goods, etc. Insolvent, a person whose liabilities are more than the realizable value of his asset is called as an insolvent person. Debtors. When goods are sold to persons on credit, then that person pays the price in future. He is called as a debtor because he owes the amount to the firm. On the other hand, creditor is a person to whom money is owed by the firm. Capital. The money or assets having money's value invested by the proprietor is known as capital, and capital is equal to assets minus liabilities. Now, what are liabilities? Liabilities are the claims of those who have lent money to the firm or who are not the owners of the firm are known as liabilities. Any physical thing or right owned that has a money value is known as an asset. Goods. Only those articles which are bought for resale for profit are known as goods. Revenue is defined as the inflow of assets which result in an increase in the owner's equity. It includes all incomes like sales receipt, interest, commission, brokerage, etc. However, receipts of capital nature like additional capital, sale of assets, etc. are not a part of revenue. Expense. The term expense refers to the amount incurred in the process of earning revenue. If the benefit of an expenditure is limited to 1 year, it is treated as an expense. For example, payment of salary, rent are all expenses. Expenditure. If an asset is acquired during the year, it is an expenditure. If it is consumed during the same year, it is also an expense of the year. Purchases. Buying of goods by the trader for selling them to his customers is known as purchases. When goods are purchased or sold out, it is known as sales. Solvent. A person whose assets with realizable values which exceeds his liabilities is known as a solvent person. Stock. The goods purchased are for selling. If the goods are not sold out fully, a part of the total goods purchased is kept with the trader until it is sold out. It is called as stock. More precisely, the closing stock. Drawings. It is the amount of money or the value of goods which the proprietor takes for the domestic or personal use. It is usually subtracted from capital. Losses. Loss really means something against which the firm receives no benefit. Some examples of loss is due to fire, theft, and damages payable to others. Account. Account is expressed as a clear and concise record of transaction relating to a person or a firm or a property or a liability or an expense or an income. Invoice. While making a sale, the seller prepares a statement giving the particulars such as the quantity, price per unit, the total amount payable, any deductions made, and show the net amount payable by the buyer. Such a statement is called as an invoice. Voucher. A voucher is a proof that a particular transaction has taken place for the value stated in the document. Proprietor is a person who makes the investment and bears the risks connected to the business. Discount. When customer receives any type of deduction in the prices of goods sold by the businessman is known as a discount. If you have any questions, please do leave them in the comments section below and we will answer them as soon as possible. Let's move on to the next topic, accounting equation. The properties owned by a business are called as assets, and the rights to the properties are known as liabilities or equities of business. Equities can be subdivided into equity of the owners, which is known as the capital, and equity of creditors, who represent the debts of the business, known as liabilities. These equities may also be called internal equity or external equity. Internal equity represents the owner's equity in the assets, and the external equity represents the outsider's interest in the assets. Hence, assets is equal to liabilities plus capital, or capital is equal to assets minus liabilities, or liabilities is equal to assets less capital. If you have any questions, please do leave them in the comments section below and we will answer them as soon as possible. The next topic is journals. Journal is a simple book of accounts in which all the business transactions are originally recorded in chronological order and from which they are posted to the ledger account at any convenient time. Journalizing refers to the act of recording each transaction in the journal, and the form in which it is recorded is known as journal entry. Single entry system records only one aspect of the transaction, which is incomplete and not recommended for auditing purposes. Double entry system records both aspects of the transactions, which comprises of the debit entry followed by a credit entry and complies to the audit rules and regulations. Let us now look at a simple list of transactions and figure out how to post the journal entries for each transaction. So in this example, BR is the person who starts Best Bakery Shop, and the following are the transactions of his bakery shop. We should understand that we are not preparing the journal entries in the books of BR, but we are preparing the journal entries in the books of Best Bakery Shop. So we have to stand in the shoes of Best Bakery Shop, and irrespective of BR being the proprietor, we have to treat them separately. So BR is an individual person in the eyes of law, and Best Bakery Shop is another individual person in the eyes of law. So they are two separate individuals, and we are going to prepare the journal entries in the books of Best Bakery Shop. So the first transaction is BR, being the proprietor, starts business as a sole proprietor with $20,000 in cash. So we've already seen that there are 3 accounts in accountancy, and these are the principal rules of these 3 basic account types. Let's recollect the debit and credit rules of each account. So personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. One more time. Personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. Now, to prepare a journal entry, we will be taking one debit of one account and another credit of another account. So for example, in our first transaction, BR starts business as a sole proprietor with $20,000 in cash. So the 2 accounts involved here is BR is investing cash as his capital into his business. So the 2 accounts involved here is cash is coming into the business of Best Bakery Shop, and BR is investing it as BR's capital. So the accounts involved is cash account, which is a real account. So we have to use debit what comes in. The other one is BR's capital account, which is a personal account because it deals with a person. BR, credit the giver. So we're taking one debit from real account and one credit from the personal account based on the nature of the transaction, and we're going to form a journal entry. Let's move on to an Excel sheet and see how the journal entries are posted. So here we have BR starts business as a sole proprietor with $20,000 in cash. So it's cash coming in to the business, and BR is providing the cash as his capital into the business. So cash is real account, so debit what comes in. BR capital account is a personal account, so credit the giver. So if we see on how to post a journal entries, so in the books of Best Bakery Shop, journal entries, and you have the date, the description, debit, credit, and the currency in which the transaction is happening. So on 1st May, cash is coming into the business, so cash account data. So if it's a debit entry, see debit, so you have to put data, and if it's a credit entry, go to the third letter and type 2 BR capital account. So how much is he investing? He's investing $20,000. So the same thing you have to put here, $20,000. And we have to give a narration, open brackets, and the narrations should start with being capital invested into the business by BR. Okay, and full stop. So this is a journal entry. It has a debit and it has a credit. The total of the debit column should be equal to the total of the credit column, so it's valid. In the same way, the next one is pays 15,000 cash into the business bank account. So in this transaction, the two accounts involved is he pays cash into bank. So bank is a personal account. So debit the receiver, the bank is receiving the cash. And from your hands or from the Best Bakery Shop's hand, the cash is going out. When I say you are the accountant of Best Bakery Shop. So you should stand in the shoes of Best Bakery Shop and post these entries. So bank is a personal account. So we take the debit side, debit rule, which is debit the receiver, because the bank is receiving the funds. And what is going out? Cash is going out, so it's a real account. So credit what goes out. So the journal entry would be bank account data to, it should start from the third, to cash account So here, how much is he depositing? 15,000. 15,000. And the narration would be being cash deposited into the bank. Now if you see here, the debit entry has a DR, whereas the credit entry has a 2 starting from the third letter of the debit entry. So this is how we distinguish which is debit and which is credit in a journal entry. A debit entry will have DR and in the ending, and a credit entry will have 2 in the beginning and starts from the third letter of the debit line or debit entry. So this transaction is now complete as a journal entry. Let's move on to the next one. Purchases goods on credit from JM for 2000. Now, when you purchase goods on credit, it means you get the goods on one hand, but you don't pay the cash on the other hand. You ask for some time. So till you make the payment to the respective person, their name has to come in our books so that we get reminded that we have to pay to them, and we have not done it yet, and they are known as creditors. So when you buy goods for resale, it comes under purchases. So purchases is when goods are coming into the business, so it's a real account, so debit what comes in. And JM is a personal account, and he is giving the goods, but he's not receiving the cash back. So personal account, credit the giver. So 4th of May, we are purchasing, so purchases, account data to JM account. And how much are we purchasing? 2000. And the narration would be being goods purchased from JM on credit. Okay, so this is how a journal entry would be for purchases of goods on credit. So the next transaction is purchases goods from ERD on credit for 3000. So again, it's a credit purchases. So purchases, whenever it's goods for resale, it should be coming under purchases. So purchases account data to ERD, because we have not paid them yet. So till we make cash payment, the name of the creditor should appear in the books so that we know that we are liable, or the payment is still pending or outstanding to be paid to ERD. So it's purchases account data to ERD account because we bought on credit. The next transaction is paid wages in cash, $60. So wages is an expense, so it's a nominal account, debit all expenses and losses, and cash is going out, so it's a real account, credit what goes out. So wages account data, to cash, being wages paid in cash. The next transaction is pays rent by check, $80. Now the difference between the previous one and this one is the rent is paid by check. Rent being an expense account, which is nominal account, debit all expenses and losses, and when it's paid by check, bank is involved. Bank is a personal account, so credit the giver. So rent account data to bank account $80, being rent paid by check. The next transaction is sells goods for cash $210. So sales takes place the same way like purchases. When you buy goods, you classify them under purchases. In the same way, when you sell goods, you classify them under sales. And you're making cash sales, which means on one hand you're giving the goods, selling the goods. On the other hand, you're receiving cash. So when cash sales is made, cash comes in. So debit what comes in, cash account data, and sales is when goods are going out. Again, credit what goes out. Both cash and sales are real accounts. So debit what comes in, credit what goes out. So cash account data to sales, being goods sold for cash, $210. The next one is buys furniture for $1,500, paying by check. Now remember, furniture is not for resale, so it cannot come under the category goods or purchases. So furniture is an asset, so it has to be named as furniture account, because we have to keep track of individual assets and their values and their wear and tear, and when they're scrapped off, we have to write them off. So furniture account debtor, debit what comes in. And how are we paying? We're paying by check. So credit the giver, the bank is making the payment via check. So furniture account debtor to bank, 1,500, being furniture bought and paid by check. The next transaction is sells goods on credit to SP for $580. Now this is an example of credit sales where we give the goods on one hand, and on the other hand we don't receive the cash, and the customer SP is saying, give me some time, give me 1 month time, or give me 2 months time, credit limit, so that I will pay you after 1 month. Some sort of an agreement we have with the customer. So till the customer pays that money to us, we have to keep track of it. So we have to bring in SP account in our books so that we are keeping track of how much he has paid and how much he's liable, how much is outstanding in his account, so that we can send reminders to him and get the payment on time as agreed. So SP is a person, so a personal account, debit the receiver, and sales is a real account, so credit what goes out. SP account debtor to sales account, being goods sold on credit to SP, $580. The next transaction is buys goods for cash, $3,900. Now this is an example of a cash purchases where on one hand you receive goods, on the other hand you pay cash. So what's coming in? Goods are coming in, debit what comes in. What's going out? Cash is going out, debit what goes out. So both are real accounts. So purchases account data to cash account, being goods bought for cash, $3,900. The next transaction is buying fittings for cash, $600. Now fittings is classified as furniture and fittings. So It's a real account where fittings is coming in, and cash is also a real account where cash is going out. So we use both the debit and the credit rule of real account to complete this journal. Furniture and fittings account data to cash account $600, $600, being fittings bought for cash. The next transaction is pays wages by cash $110. Wages is an expense, debit all expenses and losses, and cash is a real account, credit what goes out because it's going out of the business. So wages account data to cash account $110, being wages paid by cash. The next transaction is sells goods for cash $430. Now, this is an example of cash sales where on one hand you hand over the goods and on the other hand you receive the cash. So debit what comes in, cash is coming into the business, credit what goes out, the goods are going out, and by what way are they going out? They're going out by sales. So cash account data to sales account being goods sold for cash $480. Sorry, that's a typo mistake, sorry, $430. All right? Okay. Now, the next transaction receives part payment from SP of £330 by check. Now, SP is a customer to whom we have sold on credit, and now he's making the payment by check. So when it's check, it goes into the bank account. So debit the receiver, which is the bank, though it's our money, though it's the business money, it goes into the bank. So bank account data, debit the receiver, and credit the giver. Who's giving the money? SP. So bank account data to SP account $330, being part payment received from SP by check. The next transaction is pays advertising by check $25. So advertisement or advertising expenses is an expense, a nominal account. So debit all expenses and losses. And what's going out? Money is going out, but it's paid by cash. So the bank pays on your behalf. So credit the giver. Who's giving the money? The bank is giving the money on your behalf. You means you're the accountant of Best Bakery Shop, and we are preparing the journals for Best Bakery Shop. So whenever we are preparing for a company, we should stand in the company's shoes and prepare the journals. So the payment for these expenses is paid by the bank. So advertisement expenses account data to bank account, being advertisement expenses paid by check. The next transaction is again a cash sales. So debit what comes in, cash is coming in, and credit what goes out, goods are going out. So cash account data to sales account, being goods sold for cash. Sales sells goods on credit to KM for £8,090. So KM is the customer, debit the receiver, and credit what goes out. The goods are going out, but we're not receiving cash because it's a credit sales. So debit the receiver, credit what goes out. KM account data to sales account 8,090 being goods sold on credit to KM. Withdraws $100 cash for personal use. Now BR withdraws from what he has invested into Best Bakery Shop. He withdraws $100 for his personal use. So that's BR's drawing account. Debit the receiver because it's BR, it's a person. So his capital account is different from his drawings account, but later we will deduct it from his capital to find out the net capital invested. But for the time being, as a journal entry, we have to have an account separate to BR's capital account. So this which he withdraws for his personal use is named as BR's withdrawings or drawings account. So BR's drawings account, debit the receiver. And what is going out of the business? Cash is going out. So to cash account, $100 being cash withdrawal made by BR for his personal use. Commission received $75 cash. So what's coming into the business? Cash is coming into the business. And in what form? As commission received. It's an income. So a nominal account, credit all incomes and gains. So cash account data to commission received account being cash commission received. $75, $75. Okay, so these are the transactions of BR in the books of Best Bakery Shop, though BR is the proprietor, he is treated as a separate person from Best Bakery Shop. In the eyes of law, Best Bakery Shop is treated as an individual person. Hope these journal entries for the respective transactions are clear, and if you have any doubts, please do post them in the comments section below, and we will answer you as soon as possible. As I've said, please post the questions in the comment section below, and we will answer you as soon as possible. If you like this video, please do click on the like button, and if you're a new viewer, please click on the subscribe button so that you will get notifications of new videos uploaded. Please also click on the bell icon so that you are aware of the new uploads. Thank you.